I would like to welcome everyone to our webinar, FX Risk Management, Establishing the Framework for Success, which is the second webinar in the three-part webinar series, FX Risk, Managing Volatility to Protect the Bottom Line. My name is Ernie Humphrey, and I'm the Vice President of Educational Programs for Proformative, the online community for corporate finance, accounting, treasury, and related professionals. As a 15-plus year finance and treasury, I know as you do that assessing, monitoring, and measuring FX risk is confusing at best. This webinar series is about providing our audience insights regarding the current and emerging drivers of the ever-increasing volatility in foreign currency markets, identifying key factors dictating the business case for a holistic approach to FX risk management, and sharing case studies from firms on the forefront of leveraging the latest technologies and techniques in managing currency risk. The first webinar in this webinar series, FX Risk, Managing Volatility to Protect the Bottom Line, focused on offering an assessment of the current and ever-increasing volatility in currency markets and insights into the inherent and exogenous volatility in currency markets most relevant to your firms. This webinar will focus on making the business case for FX risk management, offering insights into how to establish the internal and external relationships to run an effective FX risk management program, and offer practical advice for establishing the framework necessary for a sustainable and holistic approach to FX risk management. Before we get to these topics, I'd like to thank our sponsors, Western Union Business Solutions and Fire Apps, whose commitments to supporting thought leadership in the arena of FX risk management have made it possible for Proformative to bring you this program for free. Today, we will hear a joint presentation from Andy Gage and Carl Schmada, and then we will spend the remainder of our time in an open panel discussion. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise we'll get to all of them, but we will do our best and we'll follow up afterwards on any questions we did not get to during the webinar today. Please note that we will send out soft copies of the presentation to all attendees later today. We are also proud to offer CPE credits for the CPAs in today's audience. Please send an email to twalsh@proformative.com in order to receive your CPE certificate. That's twalsh, T-W-A-L-S-H, at proformative.com, P-R-O-F-O-R-M-A-T-I-V-E.com. Don't worry, if you didn't catch that email address, Tanya will be the one sending you the webinar survey presentation later today. Okay, let's get started. I'd like to introduce our speakers, Andy Gage and Carl Schmada. Andy Gage currently serves in the role of Vice President, Strategic Market Development at Fire Apps. Andy has over 20 years of experience in consulting, product management, and marketing. As I mentioned, Andy is currently the Vice President of Strategic Market Development at Fire Apps, where he advises corporations, consulting firms, and business partners on a wide range of foreign exchange exposure management topics and emerging industry best practices. Prior to his tenure at Fire Apps, Andy held management positions at Cycle Commerce, Deloitte Consulting, and Syntex Pharmaceutical. Andy holds a BS in Business Administration from the University of Arizona and an MBA from the University of Texas, Austin. Carl Schmada, in his current role, Carl has designed and implemented risk management and trading strategies for hundreds of companies, ranging from small businesses to large corporations. As a member of the Business Solutions Analytical team, Carl also provides market analysis and strategic guidance on a daily basis for thousands of international businesses. Carl is a regular contributor to a number of international treasury and finance magazines, and this market analysis and forecasts have been widely quoted by such publications as the Washington Times and the Wall Street Journal. With that, I'd like to hand the floor over to Carl Schmada, Senior Market Strategist, Western Union Business Solutions. Carl?
Thank you very much, Ernie. We really appreciate the introduction there and definitely all your support there. Just wanted to start off by thanking everyone who's tuned into our radio show here for the second time. We're really glad we didn't scare you off the first time, telling you all about how dangerous the currency markets were and such. Today we're going to talk about some more material components here, essentially how to manage in this environment. And as Ernie mentioned there, definitely please feel free to send us questions throughout the presentation here. We'd appreciate the hard questions as well at the end. Speaking for myself, of course, right, Andy?
That's correct.
So, as we discussed in the previous session, North American businesses today are more exposed to currency risk than ever before. We've got supply chains now that stretch completely around the globe. Companies are pursuing market opportunities in places that were once considered completely off limits, to all but the very largest multinationals. At the same time, currency markets themselves are far more volatile and more dangerous than ever before. The more interrelated the financial markets have become, the more unpredictable the markets themselves are. As we discussed last time, events in Libya now have a major effect on currency valuations here in North America. And this means that companies need to look for ways to protect themselves against the currency risk while also pursuing the business opportunities that are available elsewhere and around the world. So to kind of provide an overview of what we're looking to cover here today, I'd like to first off start by discussing essentially the core goals and objectives that should underlie a risk management strategy before we discuss the strategy itself. As they say, if you don't know where you're going, you won't actually get there. So we want to talk about what motivations are actually going to derive the risk management strategy that you want to put in place. From there, we're going to set out a general strategic framework for managing risk. And as Ernie mentioned there, we're going to take a really holistic, process-based approach to the issue. Why? If anything, if you look at history, it really tells you that effectively managing risk is not about running really complex mathematical models that can predict the future or precisely calculating the odds of specific events in the future. So, we want to focus on core processes that drive performance. At the same time, managing risk cannot be accomplished by throwing a collection of financial instruments or software platforms at the problem. That's not going to make all the monsters under the bed magically disappear, to put it poetically. Managing risk is all about the underlying processes and the cultural shift that's required to accurately identify your exposures, manage them effectively, and adapt to changing circumstances over time. The markets themselves will evolve, and your company itself will evolve over time. So we want to put a framework in place that actually changes as circumstances change. And to do that, we're going to discuss some of the underlying technological architecture and infrastructure that you want to put in place, some of the communication strategies that can help to drive your success, and the cultural changes that will help your firm achieve its risk management objectives. Okay, so in order to achieve true effectiveness, your currency trading framework should be designed with three primary goals in mind. The first is achieving cash flow and earnings predictability. As we all know, the more unpredictable and the more volatile your cash flows are, the more that resource allocation becomes difficult. Research has repeatedly proven that this is one of the biggest areas of uncertainty and the biggest areas of organizational inefficiency that can truly be identified in a modern corporation. Identifying where cash flows are coming from and being able to smooth out the volatility of the cycle is crucially important to any treasurer. So we want to really increase the predictive accuracy of your cash flow forecast. We want to improve the accounting simplicity associated with the cycle of cash through the business, and we want to lower the costs and actually substantially improve the strategic planning efforts that the company engages in. At the same time, we want to manage the risk associated with currency. So we want to reduce the vulnerability of the organization to exchange rate movements, because they can compromise your profits. They can also undermine the company's ability to survive and thrive in new markets. What does that mean? It means that we want to reduce a source of competitive disadvantage. We want to make sure that the company can operate in these markets and outcompete other firms. So ultimately, we want to make sure that the bottom line is protected and that the business remains stable and sustainable in the long term. And the third focus that we want to incorporate here is opportunistic market entry. What do I mean by this? Exchange rate volatility ultimately represents both risk and opportunity. And where do risk management strategies fall down? Primarily because companies are not prepared to ignore the opportunities that can be captured when currencies move in the right direction. Now, when companies choose to focus on a gain out of the currency markets, often what happens is that they leave themselves currency risk management strategy fails to achieve its objectives, and also is often discarded when the organization goes through change. So we want to ensure that the business can actually enter the market really, really effectively. So ultimately, what are we looking to do here? We're looking to focus on sustainability and allow the company to focus on core competencies rather than on managing currency risk specifically.
Hey, Carl, this is Andy. I think as you're making that transition, I think when you look at the objectives that you laid out there in that organized fashion, I think it's important for companies to keep that in mind, because often what we see in working with our clients is that the push to deal with currency risk, if they haven't done so in the past, or if they need to heighten their sensitivity to that, can come in somewhat of a panic mode. You get the hard call from the CEO or the CFO that just had to walk through the latest analyst call, having to explain some unexpected FX impacts, or fielding questions from auditors and board members about how well prepared the company is to deal with the risk. So I think as a professional risk manager, you need to take that potentially emotional input from the organization and be able to coalesce it around those core objectives and be able to field questions in that context and be able to respond appropriately.
Absolutely, yeah, and that's really going to be the core focus of today's discussion is how do you prepare? The traditional response, as you mentioned, is the fact that a market event will occur. Everyone realizes there's big risk there, and now we're reacting to a market circumstance. And as we're doing that, all sorts of things can go wrong. So we want to make sure that everything's prepared in advance, and it's just an ongoing process versus becoming a reactive organization. So ultimately, how do we do this? We create a feedback loop between the business objectives and the tools and strategies that you're going to use to achieve them, so that you're continually adapting. Now, just to provide an overview of this, this basically breaks down to four essential components. The first is identifying or understanding the lay of the land. What exposures does a company have? What market environment are we operating in? And then we want to build a toolbox in which we're going to put the tools that we can use to manage risk. And what we've done in this framework is actually separated the choosing of the tools from the deployment of the tools, because ultimately, the strategic aspect is balanced by the tactical aspect. We want to make sure that we're choosing the right tool, but we're also going to the market in the right way. And then we also want to institute a really formal adaptation process so that the strategies and tactics evolve as the company does. Now, how do we do this? In essence, we look at we start off by identifying what's happening within the organization. So firstly, how are things currently done? What processes and strategies are currently in place? Who's doing what? And what's working and what isn't? By doing this, we're looking for areas of weakness. We're also identifying areas of improvement. And Andy will speak to this a little bit more in a moment, but essentially you want to go in and identify the specific holes in the existing processes so that we know what we need to improve on. From there, we want to look at the risks that the company is actually exposed to. So broadly, we have three types of risk. The first is transaction exposure. That's the simplest and most transparent type of exposure. It's the gain or the loss that's generated when the exchange rate that you apply to your cash flows changes over time. And traditionally this is the focus of hedging activity. Most companies will place positions against specific transactions and try to manage the risk associated with them. What we're seeing more of, and Andy can definitely speak to this, is that we're seeing more companies actually protecting risk on the translation side. In other words, the value of a foreign asset or liability that fluctuates as exchange rates move. And when these foreign assets or liabilities fluctuate, we have an implication on balance sheet values and on earnings. So we find that these vulnerabilities create volatility on both the income and the balance sheets, and really affect earnings over the long run. As a result, more and more companies are moving their risk management activities from purely a transaction-based process towards covering the translation exposures as well. Going down the road also, we have structural exposures, and what do I mean by that? That's an economic exposure, so it's an exposure that actually influences the viability of your business model. Right now, what we're seeing is a lot of companies that have exposure to the Chinese yuan, for example, and the rise in the value of the Chinese yuan is materially affecting their profit margins here in the United States. And as a result, we have an economic exposure. We have an exposure to a situation that may potentially down the road dramatically affect whether that business itself is able to continue functioning. From that, we want to look at the impact that these exposures have. And this is really highly subjective at the end of the day. There are a few simple rules of thumb. The first is that if you have 100,000 Chilean peso exposure, that's a very large exposure for a very small company. But for Exxon, it's not material. So we want to really categorize our exposures on the basis of whether they're going to materially affect earnings or cash flows. That being said, there's the subjective side, and generally what we want to do is interview all your internal and external stakeholders so that we can build an understanding of the risk tolerances and the goals that are going to derive your exposure management. And again, Andy will speak more to this, but at the end of the day, lenders, investors, your senior leadership, they all have very, very differing perspectives. And if you don't consider those, you can wind up making missteps, and that can materially affect whether the risk management framework remains in place over the long term. Now, beyond that, we want to put that into material terms. So we want to perform a sensitivity analysis on earnings and actually quantify these tolerances in terms of probabilities and percentages. So we want to actually understand whether a 15% loss is going to affect earnings substantially, and whether senior leadership is willing to accept that risk. Based on that, we then know how to strategize. Now, ultimately, these are really, really very nice sentiments, and it's good in theory. But how does it play out in the real world? Andy, if you want to talk about some of the challenges here.
Yeah, when a couple of years ago, we actually did a survey with one of our business partners, and the survey went out to about 275 corporate treasurers. And the focus of the survey was to say, given your exposure management program today, what are your top challenges? And as Carl mentioned on the previous slide, as you begin to think about developing a risk management policy and developing an understanding of what risks you have, one of the first steps that you need to execute on is identify what your exposures are. And depending upon the type of exposure that you're talking about, that can be a difficult issue. And most companies today would tell you that getting an accurate, timely reflection of their exposures is a very difficult challenge, to say the least. And that is due to a variety of issues. If we go to the next slide and we talk about a certain class of exposure, so if we talk about the types of exposures that ultimately manifest themselves in terms of cash flow exposures, this is more art than science. When you're dealing with forecasted exposures, this could be coming from different parts of your business. You could have some parts of your business that are providing forecast information or planned information in a US dollar format, some in a euro format, some with transaction currency detail that would be appropriate for a treasurer to be able to resolve into what the true exposures are. And it's difficult to piece this information together to get a consistent, true understanding of your exposures. And as you think about going through this process, one of the themes that you'll hear us at FireApps continuously put into the marketplace is approach this as a cross-functional team. Bring together treasury professionals, accounting, the business units, and have them working together, because at the end of the day, although treasury has a main influence on the overall impact of foreign exchange on the income statement, it is truly an enterprise responsibility, and it is incumbent upon the people that have something to do with the input or the reconciliation of business processes and data within the accounting systems to understand their impact on that. There's a huge appetite for education in this area. So best practices that we've seen are getting those collaborative teams to come together to help identify what those sources are, We've seen companies use techniques from lean manufacturing or Kaizen or operational excellence that they drive a project management focused approach to identifying those flows and how currencies flow through the business. But as you bring that together, you do need to empower a single process owner that is ultimately going to be able to bring all this information together and formulate an understanding of exposures and be able to do the quantitative financial analysis that is ultimately required to understand the true risk here. If you move to the balance sheet, there's a different set of issues here. And the balance sheet information is going to be referring to the monetary assets on liabilities that are more short-term in nature. These are going to be your cash, your AR, your AP positions that are booked or will be booked within a very short period of time. And one of the things that we found in working with our clients is that there can be a lot of issues that are sitting underneath the surface that make it a lot harder to get an accurate reflection of your exposures. We see disconnects between what Treasury thinks should be remeasured and what should be managed. So there's a disconnect between accounting and Treasury in some case. When you deal with the different types of ERP systems that are out there, whether it's SAP, Oracle, PeopleSoft, you name it, they all have their own little idiosyncrasies that can make it difficult to isolate the underlying source data for exposure. SAP can have structures in there where they potentially overlap each other and in effect nullifying how the revaluation rules. So getting a surgical extract out of SAP for a lot of companies has proven to be very, very problematic and inaccurate at best. Oracle has its own set of quirks in there. There's also a phenomenon that we see as we start sourcing data out of these accounting systems that indicates that there are behavioral problems within the way that the companies are actually recording and relieving multi-currency transactions. They will leave phantom balances in the general ledger that could lead to a false positive in terms of an exposure. So again, key to success here is making sure that Treasury is not the only one holding the bag at the end of the day when the FX gain loss numbers are calculated. There has to be a collaborative approach and understanding that the controller, the IT organization, the people within tax and the business operations all have to understand that they have a role to play in ensuring that the data that is used to calculate a currency exposure can be as accurate and clean as compliant. I think the other thing that is important, and we touched on this, if you look at the diagram that Carl has got here, this is an iterative process. You can't wait a year to go through this analysis again. It should be something that is done on a continuous basis. So if you do find issues with the way that exposure data is manifested in the underlying systems, you can take the time to clean that up and do it continuously versus having to go in every year or 2 years and do a cleanup. But given that approach, and we've seen a number of companies and we've helped a number of companies go through that process, you can get a very accurate understanding of your exposures. You can clean up the accounting process at the period end, and at the end of the day, you're going to have a lot more confidence in the underlying data that you use for financial decision making.
Yeah, and as Andy says there, the more information you have, the clearer the objectives are going to be here. So we want to take all of that data, we want to parcel it into a really formal policy framework, and in a lot of cases, most of the companies listening to this call today, I would expect, would have formal policy frameworks in place. Now, the primary thing here, the starting point for every policy framework is answering basically 4 questions: the why, the who, the when, and the what. And I think probably the why is the most important question here. What are the motivations for managing your risk? Are we looking to smooth cash flow volatility? Are we looking to outperform the market? Are we looking to speculate, for example? A lot of companies will simply have a statement that says that positions will not be placed for speculative purposes. And ultimately, we want to articulate these motivations. We want to actually adjust the corporate culture. And Andy, can you speak to that a bit, how we might communicate this internally?
Yeah, I think there's a lot of dimensions to the organizational readiness for addressing currency risk. And a lot of that comes down to how does the business operate on a day-to-day basis. I'll give you a good example. We were working with one client on the West Coast that recognized that they needed to deal with currency risk in a fundamentally different way. Historically, they have been looking at data on a monthly basis, and the FX results were not really where they needed to be. They were taking some material hits that they needed to see eliminated from the impact of the financial statements. As they started thinking about that, one of the things they realized that they actually needed to do accounting differently than they did today, or than they were doing historically. And one of the things that we have seen companies need to do more and more, given the surge in volatility that we're seeing that seems to be holding its own right now, is move towards more timely accounting closing. So in doing that, the Treasury team, working with the controller's team, had to go out and assess how things were being done today and what steps could be taken to do at least a weekly close so that they could at least adjust their positions on a weekly basis. And that takes some time. But that type of insight is now going to be part of the overall organization's view that everybody has a seat at the table in terms of understanding the currency risk, and that processes need to change to adapt to that. So that's one story of many.
Yeah, and that definitely ties into, the next point there, and that's identifying who's accountable for what. And, the traditional approach, and I'm sure Andy would agree, is that you set up a series of signing authorities and assign them trading limits. Now, this is not truly managing risk. It simply compartmentalizes the risk. So many companies have expanded the accountabilities for risk, for currency risk in particular, outside of the traditional financial roles. The more the organization is distributed rather than hierarchical, the more risk can pop up from anywhere. A buyer in India or a salesperson in the United Kingdom can inadvertently expose the company to really significant currency risk. So it's important that they're not only aware of this risk, that those players are not only aware of the risk, but that they're also accountable for the actions. They have to be tied into the risk management structure. And at the same time, we want to set out very distinct process timelines. We want to make sure that risks are covered in a specific time period. The more time that elapses between an exposure being identified and when the offsetting hedge is placed, the greater the financial risk. And speaking from my side, the more that subjectivity comes into this process, the more risk is on the table. The more that a treasurer can sit on a position and leave an exposure to the whims of the market, the more time that they have in that process, the more risk or the more material the risk can become. So within the process framework, we want to really specify the event that triggers the analysis, establish the measurement process used to define and prioritize the exposure, and then communicate really clear deadlines around when the exposure must be reported internally and when offsetting positions must be placed. From there, we want to really identify what we're going to do about the exposure. And ultimately here, we want to build a toolbox that has a number of tools in it that we can use to actually address the risk. Now, what I would like to emphasize here is that the traditional focus is to look at the tool first. I think that within the modern risk management framework, we want to look at the criteria first. We want to look at, firstly, hedge effectiveness. And ultimately, this is the most important factor. If you're going to choose a tool, you want to make sure that it truly mitigates the targeted risk. It should match the currency and the timing of the underlying business requirement. It should also identify a really clear worst-case protection level against currency movement. In other words, we want to make sure that we know where the floor is. And knowing where that floor is very, very important, both internally from an accounting perspective when we're putting it into our systems, but also in terms of communicating the effects and the scenarios that can unfold internally. We want to make sure that we can explain internally what is going to happen under what circumstances. We also want to look at certainty. We want to make sure that if we are putting a hedge in place, that the underlying requirement will come in with a reasonable degree of certainty. In other words, we don't want to create an exposure that we didn't have before. Another factor that is extremely important is timing flexibility. In the business world, cash flows are really, really rarely predictable. So we want to make sure that the instrument that you choose allows you to settle earlier than you expect or efficiently deliver late. And the way the currency markets are structured, this is actually relatively easy to accomplish. Interest rate differentials are relatively minimal when it comes to managing risk, and the tools that are used can be really, really flexible as far as timing is concerned. So one of the things that we've seen over time is that whereas previously companies did not hedge because they were uncertain as to when the funds would come in, now they're realizing that the decision as to whether to hedge the foreign exchange risk should not be hinging on timing uncertainty. It should be hinging on whether the actual settlement is expected and to what degree of accuracy that will occur. At the same time, we also want to look at participation. So the reality is that a really strong hedging program can be a short-term competitive disadvantage. If exchange rates move favorably for your industry, the performance of your company may lag others if you are fully hedged. So we want to make sure that that you retain some exposure in the event that the market trends in the right direction. And we also want to maintain downside protection to make sure that you're protected in the event that something really goes wrong. And this next category, I would certainly say that Andy has extensive experience with. But at the end of the day, hedging instruments can streamline accounting procedures and reduce your reporting complexity, but there are also instances where this isn't the case. So we really want to factor the accounting implications of an instrument in when we decide what tool to deploy. And ultimately, that also relates to the fact that when all other factors have been considered, choosing the least complicated instrument really has clear advantages. You want to understand the mechanics of the tool, you want to understand how it will perform over its lifetime, and you also want to be able to articulate the benefits of that strategy at the senior leadership level and beyond. Like when you're talking to your lenders, you want to be able to explain exactly why you're doing what you're doing. And at the end of the day, we want to ensure that we're really deploying a balanced array of instruments and tactics. That helps to achieve efficiency. It also helps to improve your risk management performance when market conditions change dramatically. And ultimately, one size doesn't fit all. Now, the big important factor here is that there is a cost-benefit ratio here. The reality is that many instruments will have implications. There is a cost-benefit ratio associated with any given tool. Andy, did you want to go into that there?
Yeah, just to kind of walk through this very quickly here. I mean, if you have an understanding of your entire exposure, you can then model what the overall risk is based on the portfolio of currencies that you're looking at. That's one of the things we're very strong advocates of is look at your currencies as a basket or a portfolio. Once you understand that, you can then calculate what the overall risk would be. And if you have existing hedge positions that are in place, you can understand what the cost benefit of that would be based on the underlying interest rate differentials of those hedges. So what you're seeing graphically depicted here is a company that had roughly $23 million and $24 million of risk. They had achieved some level of risk reduction because they had hedged a certain number of currencies. But in their case, they had hedged only a fraction of the currency exposures because prior to automating the entire process, it was very difficult for them. But when looked at in totality, the efficient frontier that's represented on the left there shows that they could have a significant amount of risk reduction and actually generate some interest income, which is a way to look at the cost benefit of managing that risk. So the conversation that the treasurer is now able to have with the CFO is, where do you want me to be on this curve? Do you want me to take risk to zero? If in some cases that line can go into the interest expense side, then you need to say, well, if I've got a Brazilian real exposure that's very expensive from an interest rate differential standpoint, how much of that do you want me to hedge and how much risk reduction, how much are we willing to spend to manage that risk? And that's a different conversation that's being had within boards and CFO level suites around how to look at currency risk from a portfolio versus just a currency pair perspective. So when you look at the available ways to mitigate exposure, one of the things we always like to look at is what things can be done internally to reduce or eliminate exposure and make sure that you're making the most cost-effective use of internal mechanisms. So cash flow netting, looking at how certain flows may net against each other in terms of probability and timing. We've seen looking at how your functional currencies have been designated. One of the things that we're seeing a lot of is as companies are going through these acquisition modes right now is when they bring in new companies, they're having to revisit the entire functional currency strategy because of the ways that currencies are actually flowing through the business. And that can have a dramatic impact on how currency exposures represent themselves, especially on the balance sheet side. Natural hedging is also a natural outgrowth or a nice way to look at, can I get some offsets between my AR and my AP and looking at this holistically. And the last piece is organic exposure elimination. Can we find opportunities within the balance sheet specifically where or on intercompany flows where we can just eliminate positions or eliminate exposures just having that visibility. We've seen companies before hedging eliminate 20 to 30% of their exposure through that combination of tools. You want to speak to the external?
Sure. So, at the end of the day, there's a lot of literature out there on the financial instruments that can be used to manage risk. So we're just going to provide a brief overview here. If you do want any further in-depth analysis, please feel free to get in contact later. So basically, we have three types of transaction. The first is a spot trade. That is when you wait until a transaction has to be settled before you actually agree on an exchange rate. Ultimately, this is a strategy used by very few companies at this point in time, mainly because unfavorable movements directly impact the value of that cash flow. So companies have really adopted usage of forward or swap-based instruments. What these do is they book an exchange rate today for delivery in the future. And the cost of that type of contract is derived from the difference in interest rates between the two currencies being traded. So it does not reflect market predictions of exchange rate movements, and ultimately becomes one of the most cost-efficient and flexible tools in existence as far as the finance world is concerned. So what we've seen is that these swap-based instruments have really become the bulk of most corporate hedging programs. They can be purchased in most of even the most exotic currencies in the world have deliverable forward markets these days. And this means that it's really, really easy to directly target a risk that's on your books. Of course, the downside to something like this is that the fixed exchange rate limits your ability to gain when the markets shift favorably. So we're also seeing increased adoption of option-based instruments. And what these do is they balance downside protection while creating opportunities for participation in the event that the market moves the right way. Now, this is a form of insurance, and so as one would expect, they are more expensive and less efficient than the forward-based strategy, but they do definitely fit into a corporate hedging framework and can offer significant value. Now, at the end of the day, any strategy will not survive tactical implementation if that's not done well. So when it comes to the markets, we want to make sure that we have situational awareness. We want to understand where the markets are at, what the environment is. If we can understand what the consensus forecasts are, if we can understand what resistance levels are out there, what political and economic environment we're operating in, we can actually gain benefits out of the market movement. So we want to look at the recent trading range, and we also want to enter the market really, really tactically. So we want to look at managing volatility versus direction. What do I mean by that? If you look at this chart, this is the U.S.-Canadian pair over the last 5 years, and you can see movement in two different categories, basically two types of amplitude here. We have diffuse movement, where markets move very little over long periods of time, and we have extreme moves. So we want to manage both of those types of move. Generally, how does a corporate do that? By instituting limit orders and things like that to protect against extreme moves. So overall, for this whole framework, we want to review this very periodically. We want to get into it on a daily or a weekly basis, as Andy mentioned there. And we also want to benchmark our performance against internal objectives versus benchmarking against the market. Andy, did you want to talk to that a bit?
Yeah, and I think for companies that are looking at getting into this or even revisiting this, there's a lot of things that go into the benchmarking. Obviously, you want to do period over period FX gain-loss attribution analysis. One of the things that we've seen a trend in, I don't know if it's a major trend or a micro trend yet, is auditors pushing more companies towards using daily rates for evaluating transactions within the balance sheet, moving away from a single rate. So that does create some additional complexity for those companies that need to do that FX gain-loss analysis month over month, because it's difficult to see what the realized and unrealized gains are on an inter-period basis. So just make sure that you understand, what your environment is when you start to do that benchmarking. And again, strong collaboration between Treasury and the accounting organization are paramount in being able to do that correctly.
And at the end of the day, companies now are producing performance documents on a periodic basis. So the performance document allows you to adjust the policy. It identifies the areas where the strategies are not matching up with realities. So we want to make sure that the entire policy adapts as circumstances adapt. And as Charles Darwin said here, it's not the strongest of the species that survives, nor the most intelligent, but the one most responsive to change. That definitely applies to the typical corporate operating in this environment. You want to adapt to the environment versus trying to anticipate it. And that really brings me to my next point as well, and that's that volatility is really the only certainty. The reality is that all the economic forecasts in the world cannot help you to determine where the markets are going to go. I believe it was John Kenneth Galbraith, he said that the only function of economic forecasting is to make astrology look respectable. So the key in this environment is to really harness short-term volatility while protecting against the big moves. So you want to focus on entering the market effectively and picking up incremental gains as opposed to the windfall gains that many companies pursue. Whenever you're pursuing that, you can wind up exposed to significant risk. So ultimately, we want to make sure that you're prepared versus reacting to the market. We want to make sure that your process is ongoing so that when an event does occur, you're able to go into motion. And that's really a lesson that the best currency traders in the world would attest. Really, at the end of the day, luck is a matter of preparation meeting opportunity. And that's very, very true of the trading world. Now, Andy, if you want to talk about the infrastructure underlying all this.
Yeah, absolutely. As you begin to think about laying the foundation for a risk management program, there are technical enablers that can allow you to gain traction very quickly in being able to identify and understand your exposure. So what you see depicted here is becoming sort of the reference architecture, if you will, for corporates to deal with currency risk. Now, not everybody needs all of the different pieces that are shown on this slide here, but what you've got on the left here are going to be the sources of exposure. These are going to be your accounting systems, your planning systems, whether it's SAP, Oracle, Hyperion, Cognos, spreadsheets, what have you. There are a number of sources within your business today that contain exposure data. What we're seeing more companies do is now implement a very effective and robust pre-trade exposure analytics and decision support. And the role of pre-trade exposure analytics is to harness the information from those exposure sources, get you down to a data environment that you understand, that you can trust, and that you can use for decision making. So you got to make sure that you've got all of the information that you need, and that information has integrity. So you need not just the, what's my position, but what's underneath that position that I can gain transparency to believe that number. On top of that, you need to, within that pre-trade environment, inject your policy and your preferences in terms of how much risk you're willing to take and how you want to manage that risk. Downstream from that can be the execution side of this. So taking those trades, working with the trading platform. And that can be going through a liquidity provider, a financial partner, a trading platform or trading portal. It's really not any one technical capability. It's really about the act of trading and then doing the post-trade accounting and reconciliation. So having all of those pieces together, whether that's in a system or within a process supported by spreadsheets, is really becoming the way to think about the logical pieces of the overall architecture. Now, the good thing is there are robust technologies that play a part in this. And when we get to our next webinar in the next session here, we'll go into a lot more detail about this type of architecture and how different companies have deployed this and what were their goals and objectives in deploying these new architectures to manage that risk and be very cost-effective in doing it. So with that, I think I've just kind of done a quick synopsis of the technical stack that we're seeing more companies adopt in managing this currency risk. Carl, did you have any closing comments?
No, I think that's a good outline of what we're going to cover in the next session. And as mentioned earlier, this was a really brief and high-level overview. So I think the devil's in the details here, and we're both available to discuss all of this in further detail as well. Ernie, did you want to wrap us up here?
Sure. Thank you. Thanks, guys. That was great content. Awful lot of content. So again, I'd like to start the Q&A session. So Please feel free, as a reminder, if you have a question you'd like to have it answered, please enter your question in the panel. Just visit the questions area in your go-to webinar control panel. So we'll take some questions for our panelists here. So let's go ahead and kick this off with a question. Is the same criteria used to build a holistic approach to FX risk management for both small businesses as well as large companies?
Yeah, definitely. I would say that the same basic fundamentals are in play. The complexity that you get to certainly grows higher as the organization grows in complexity and size. But at the most basic level, you're still going to want to go through the same procedures. And arguably, the importance is even higher for the smaller businesses. The foreign exchange exposure is much, much more material in a lot of cases, and this means that the smaller business really needs to take a more formalized approach to managing the risk. Historically, we were the other way around. It was the very large companies that deployed the really complex architecture here, but we're definitely seeing smaller and smaller companies adopting that now.
Yeah, I would also concur with that, and I think the other thing that you have to understand is that for the smaller organizations, they typically don't have the benefit of having an on-staff capital markets team. So they need to be much, much more efficient, and technology can definitely enable that, but the same principles apply, and I 100% agree with Carl's perspective on what may be immaterial for a large corporate can be very material for a smaller corporate, and we've seen single-digit or a $500,000 foreign exchange impact can have a profound impact on the company's net income and earnings per share.
Okay, just a question now. Are there any hedging instruments that do not expose the company to counterparty risk?
Yes, at least in the sense that the internal methods that we were discussing can eliminate some of the counterparty risk that's out there. But at the end of the day, other than a centrally cleared swap, although even in that case you have exposure to the clearinghouse itself, every financial instrument does have counterparty risk, yes.
Okay. Can you please explain the organic exposure elimination strategy and how it works? So you can just maybe speak to, what are natural hedges? How do you identify those opportunities there?
Sure. Well, from a natural hedge standpoint, a lot of times, especially if companies have been doing more of a transactional exposure management process where they're trying to tie specific hedges to specific AR or AP positions, if we're talking about simple balance sheet related exposures, they can potentially be hedging too much exposure because they're not looking at what the netting is between the AP and the AR position. So from what we see as a best practice is when you're looking at, we'll keep it simple for balance sheet exposures, you should look at it holistically. You should look at your cash, your AP, your AR, your intercompany in totality to see what the net exposure is, because you will find that you do get that netting across the various monetary asset and liability classes. Organic exposure elimination takes it a step further because this is an active process where Treasury and accounting are monitoring what's going on within the business on a day-to-day basis. And they may look at an intercompany relationship. One of the things that we see creep into businesses that are very complex, have very complex intercompany relationships is something as simple as I have two entities doing an intercompany relationship, but they're doing it in a third currency. So it's not, they're doing it in a currency that's not a functional currency of the businesses they're doing it. So I've got a euro and a US dollar entity doing an intercompany, but they're doing it in yen or Canadian dollar. So being able to identify those types of anomalies within the business processes or finding excess cash balances that are sitting in bank accounts that quite frankly just need to be closed out or converted, you can go in there and very aggressively clean up the balance sheet and clean up your business processes to take exposure out of the business. And I have one client, that's their only vehicle for doing exposure management, and they've, over 3 years, eliminated 60 to 70% of their exposures. Now, that's not for everybody, but it can be a very effective tool in cleaning up the balance sheet and managing exposure.
Yeah, and just to kind of layer on top of that there, Andy's talking very much about the organic side. One of the things that often occurs is that you see companies that are looking to naturally hedge by moving operations into a foreign country. For example, they're earning revenues in Egypt and they move manufacturing facilities into Egypt. One of the things there is that you can also go overboard. You can actually add risk to your books by doing so. You're eliminating currency risk, but you're actually adding political and economic risks there. So it's really important to balance those objectives.
Yeah, great point.
Okay, I got a couple questions that kind of flow off each other. One of them is, do you see a common rough breakpoint in terms of FX scale before FX risk management programs are implemented? And I would say almost, i.e., what are the main drivers that make a holistic approach make sense for a company in terms of ROI?
I think that, as Andy mentioned earlier, there's a number of catalysts that will often force a company to adopt a strategy like this. Certainly if you do take that earnings hit that is FX related, you're going to want to institute a process like this. But the other, I think the one area that we're really seeing, particularly in the United States as companies expand elsewhere, is that it becomes a competitive advantage. The better you manage your foreign exchange, the better you're able to compete internationally, against European companies and also against companies in the United States. So I think that holistic approach is really becoming part of company cultures and really part of their architecture itself. If that jives with what you would say there, Andy.
Yeah, definitely. And I think, to your first point, there's a number of factors that can motivate an organization. It really comes down to risk tolerance. And, I've got examples of clients where you would think they wouldn't be compelled to manage currency risk. They're private equity backed, more focused on cash flow, so they do want to understand the cash flow impacts, but historically don't really care about balance sheet exposure. When they went to refinance, they changed the debt covenants to be net income focused versus EBITDA focused, and very quickly there was a panic attack that said, okay, we need to deal with currency risk because that does have a profound impact on our net income. So it really comes down to Carl's initial statement at the outset, which is need to do very good stakeholder analysis. What is the board's perspective? What is the executive's perspective? What are external stakeholder perspectives? How do the auditors want to look at this? As well as what are the local business operations? How are they impacted by currency risk? And then what tools can you apply to that? But it really comes down to each company's own risk tolerance and their comfort level. I've got companies in the same industry with diametrically opposed risk management policies, some that will hedge and some that will not.
Yeah, and I think if there's one black and white phenomenon here, it's that all of those stakeholders are adding more value to this all the time, or assigning more value to it, I should say. Risk management is on everyone's radar, and I think in particular the lenders. The lenders are focusing on this more than they ever did before. I think it was something that really flew under the radar previously, and now lenders are actually asking to look at the risk policy.
Sure, great. I think that obviously we've identified one of the biggest challenges here is building that internal consensus. So there's kind of a question here on as far as what you guys have seen. Are there any generalizations that you can share, success stories on how to build internal consensus and building this holistic approach? And then how do you engage the operational people whose decisions drive FX exposures?
I'll jump in there right off the bat. The best way to do it is to scare everyone. but truly, at the end of the day, I think that companies often do move along without realizing the materiality of the risks that they're actually exposed to, without actually, often realizing the history of it. The fact that currencies do move 20 or 30% over a 1 or 2 year period, you tend to forget that fact. Now, Andy, if you want to talk about how you actually communicate that in a nice way.
Yeah. Well, I think one of the best practices environments that we've seen is a formal risk management steering committee. And that's going to have, seats at the table for the treasurer, the CFO, the controller, tax people, as well as representation from the local business units, because everybody has either something to gain or something to lose or something to input or impact how companies are impacted from a foreign exchange standpoint. So We see monthly, if not quarterly, risk management steering committees getting together and talking about key things that need to be focused on and issues that have come up through day-to-day operations. The other thing that we've seen as highly effective is when issues do come up, and they will, around how accounting is being done and how that impacts foreign exchange, or how different risks are being visualized within the organization. Again, going back to that cross-functional collaboration, a number of companies have taken if they have an operational excellence or Six Sigma or lean philosophy, they'll take those programs and do some sort of a green belt or black belt program, Kaizen event, to go in and triage these issues when they come up and get a very quick win on cleaning up certain parts of their business that are creating unnecessary noise in the FX gain loss performance. And if people would like more information on that, we do have some additional material that we can provide over to help you understand how to set up those programs and deal with that.
Okay, just have a question, maybe a little bit tangential, but I don't think so. What are your thoughts on, I know it hasn't played itself out yet, but as regard to the Frank-Dodd bill, what do companies need to look for as the implications of the Frank-Dodd bill unfold in terms of FX risk management, as far as keeping themselves educated on what they need to pay attention to as far as disclosures and even the instruments they're allowed to use going forward?
I think that's the plain fact of the matter is that the more regulation there is, the more complex the operating environment is. And really, as Andy mentioned several times throughout today's discussion, that cross-functional team is the key to managing in that environment. I think that bringing in accountants that understand this is absolutely key. It's not something that you can manage yourself in general.
Okay, just a closing question here, and then we'll wrap things up. And this is a question for me, I'll be honest. There's been quite a bit of ground covered today. I'd like both of you to answer this question. What are the top 3 things that our people on the webinar should take away from our session today? If you could give them 3 main points, what would they be to take away from today?
Carl, I'll let you go first.
Okay. I guess number 1 would be, to prepare versus reacting to the market. 2 would be to really bake this process into your organizational culture, versus taking it as simply as a webinar or taking it as a policy document. This is something that should be shared within the organization. And at the end of the day, too, the reality is that what we want to bring out of this is it's an adaptation process. To look at the foreign exchange component of your business and look at that as a competitive advantage, that the more your business can adapt to the environment, the more successful it's going to be.
Yes, I would echo much of, if not all, of what Carl has put on the table, and I guess I would add to that is, a cornerstone of this entire process and anything downstream from this is having a true and accurate understanding of your exposures. And the more that you can make that a truly data-based analysis, where you can really dive into what's really driving the exposures and get away from the anecdotal evidence or a short version summary of what you think your exposures are, then everything else from that becomes much more meaningful and successful. You'll be able to have fact-based conversations with the business instead of, I saw this happen this quarter. Well, that's it's not really a true reflection of how things are done. The more data that you've got at your fingertips, the more analysis you're going to be able to do, the more you're going to be able to get the additional parts of the organization that need to partner with you in helping you understand the risk and how to manage that. You're going to be in great shape there. So definitely understand your exposure. Use that as a basis to truly understand your risk and gain an understanding from the executive team on what their risk tolerance is, and then make sure you build a very definitive business case on the cost benefit of managing that risk. And to Carl's point, you got to keep doing this. Especially in the crazy currency markets that we're dealing with right now, combined with the constant appetite for growth. Every time we see the Wall Street Journal, we're seeing another acquisition on the line here, and that changes your company. So this isn't just something you do once a year. It's event-based. If things change in your environment, you need to revisit this entire process and make sure that you understand your exposures and your risk, and be able to adapt with the business environment as it constantly changes.
Okay, that was fantastic. I'd like to thank Andy Gage and Carl Schmada for their valuable time and insights, and also thanks again to our sponsors, Western Union Business Solution and Fire Apps. I'd like to thank the audience for your time. I know your time is very valuable, and I hope that we've provided a good ROI for your time today. Along those ends, we'll be sending out a survey to you yet today, and we very much appreciate your input as we always strive to get better and improve the ROI for our events that we offer to our attendees. And as we mentioned earlier, we'd like to invite you to the final piece in our 3-part webinar series, which is really going to focus on the case studies and get into how this technology is being leveraged by firms. And the firms are going to range from people that are just starting out and then implementing an FX risk management program to firms that already had a good FX risk management program in place and putting them together. And that webinar is being held on May 10th. So again, thank you everyone again for your valuable time. Have a great day, and we very much appreciate your support of Proformative. Thank you, everyone.